When it comes to bond funds, this one thing will determine your success of being a bond fund investor, or if you should just throw in with the index instead. I did a blog post earlier today, which I'll share with you here shortly, comparing Wellesley Fund from Vanguard to the Vanguard Target Retirement Income Fund, which is comprised solely of index funds. And my conclusion has always been on bond funds, is to avoid an index fund for bonds. And the reason you should avoid the index fund, as I shared with you in my video I just did, was taking Mr. Pablo for a walk, is because the biggest indebtors, i.e. U.S. government and the most indebted corporations, are the biggest constituents of the bond fund index. That's just a fact. And if you look at the numbers, which I'll share with you shortly, is heavy into U.S. Treasuries. There's just no other way around that. I mean, the bulk of the portfolio is U.S. Treasuries. I don't think that's very favorable, frankly. What you want on a bond fund is you want to find a guy or a lady who can manage bonds, and they do it at a fair price. So the one thing you have to determine your ability to outperform the index is the expense ratio. Literally nothing else matters. And let me show you what. So a friend of mine took issue with my assessment that index funds are suboptimal relative to actively managed bond funds. And he showed me this study he's reading from a book. And this is just basically saying we got three types of bond funds. We got small, short, intermediate term, and long-term bond funds. We got government and we got corporate bond funds. And how many bond funds underperformed the S&P index relative to the short, intermediate term, and long-term bond funds? If you look at long-term bond funds, 97% of all actively managed bond funds underperformed the S&P index for that category, going from 2001 to 2016. Not a huge track record, but it was 15 years. Intermediate bonds, 82% of government bonds underperformed, and 73% of corporate bonds, and then the same thing relatively was short-term bonds. So his premise is, look, man, you can't beat that. I mean, my goodness, of the long, the intermediate, the vast majority of bond funds underperformed the index. You can't beat it, just join the index. That's mistaken, because I'm telling you, the easiest way to find a bond fund which is going to beat the index is to find out if it's a low expense ratio. So let me show you this. This is the Vanguard Total Bond Market Index, which I'm going to compare here with you for just a second. This index has been around since 1987, so we have a pretty significant track record of this fund. And the expense is, I think it's like 15 basis points. What was it here? Yeah, profile. I think it's 15 basis points. Let's see. Hold on just a second. Let's give us a hard time. Where is the expense? Right here. Doesn't say it was 15 basis points. I'm not sure why they're not showing it. But anyway, so 15 basis points. And again, a basis point is 1 basis point is 1/100th of a percent. So 1 basis point is there's 15 basis points. So it's very cheap for sure. The problem here, though, of course, is if we go to holdings, you're going to see what it has. The vast majority of this fund is going to be government bonds and government sponsored entities like Fannie Mae, Freddie Mac, Federal Home Loan. I'm not sure what it's not give us a hard time. But anyway, the vast majority of the holdings are going to be government bonds. So essentially, this is a government bond fund with some heavily indebted corporate bonds in there as well. Because again, the biggest constituents is a cap-weighted bond fund, a cap-weighted index. The biggest constituents are the most heavily indebted corporations and governments, of which the U.S. is by far and away the biggest. And what you see here is we look, AAA, I don't know why they don't call U.S. government, that's weird. They say nothing for U.S. government, but it is U.S. government. So AAA rated are literally U.S. government bonds. And you'll see the biggest holdings by far are Treasury notes. So nothing comes close. Government bonds are the biggest holdings by far. So I just say, look, if you want a government bond fund, just buy the doggone government bond fund. But the problem here is that this is not very diversified. It's seriously swayed or skewed towards government debt, and the biggest debtors on the corporation side for sure. And so I don't like it because it's a government bond fund with heavily indebted corporations. All right. Now it's it's highly rated. I mean, look at this. It's it's got 4-star Morningstar thing for the fund. Let's see, performance and risk is 4 stars. Not a whole lot of risk because it's heavily government bonds. So you're not gonna get a lot of up and down. You're just not gonna make much money. 5-year average return, I guess I don't do the 5-year, but average return is 2.13. That doesn't bother me so much. But let's go to my favorite bond fund, which is the USAA Income Bond Fund. I don't know what PACER, USAIX is a USAA Income Bond Fund. I'm a huge fan of this fund. It's been around since 1974. Let's see, I think it has 50 basis points, which is a little bit more expensive than I would have liked as the expense. Man, why does it take us to get along? Anyways, about 50 basis points is there you go. It's still not showing up. I'm not sure why it's showing up. The expense is 50 basis points, so about 3 times that of Vanguard's fund. 4-star rating, that's fine. But if we go down to holdings, actually, let's go to holdings here. There we go. You'll see, well, it's heavily in U.S. government debt. And again, I'm not sure why they're saying 0 for U.S. government. AAAs or U.S. government. It also goes down to AA, single A, triple B, even a little bit of double B bond funds. It's going to have some financial services, going to have some energy, going to have some communications. It's very spread around, very broad-based bond fund. All right, and you can see it's 95% bonds, a little bit of cash, and a tiny little bit of stocks, 2.1% convertible stocks. So, essentially, it's a bond fund. It's not essentially. It literally is a bond fund. I don't know why they don't say expense ratio here. It's weird. But anyway, from a risk reward, it's 4 stars, just like the other fund was. Morningstar rating 4 stars, fine. Here's their biggest non-corporate SBA Tower Trust. I have no idea what that is. Nationwide Mutual Insurance Company is the largest, second largest non-government holding that you have right there. So because it's is actively managed, it has the ability to go anywhere their opportunity exists. And as I've said a couple of times now, the bond market dwarfs that of the stock market without question. All right. So that's all great. So let's take a look at performance. All right. If we look at performance, we're just going to go to our my little table here, and we're going to compare the two. And we'll say, well, if you were going only into the actually not BND, it's actually VBMFX. I don't know why I started in 1990. I just felt when the VBMFX started in 1987, for some reason I just started in 1990. I don't know why. But anyway, so what I did is I took these two bond funds. I said, let's compare them over, year over year. We'll just look at the total proceeds. And if we're taking 5% a year off, what would the funds look like? Now, remember, right now, and here's even more important, why the number one thing of bonds is the expense ratio, because you're not making any money in bonds anymore. I cannot stress this enough. You're not getting a high yield like you were before. So the higher the expense, the more it's going to hurt you from a return perspective. So the 10-year treasury right now is at 1.646. That's not enough to get the job done. That's not good. So you're getting 1.6% on a 10-year treasury. If you are paying a high expense bond fund, you're literally essentially, let's just say at a 1% expense ratio for a bond fund, and you're only getting 1.6 on the yield. You're literally leaving 2/3 of your income on the table to your fund manager. Don't do that. And that's why when you see this kind of report right here that says, look, the vast majority of bond funds can't beat their index, well, because they charge too much. It's just no other way around that. You got to find the bond funds that don't charge as much. And I would say 52 basis points for the USAA fund is probably even the high end. But I just love this fund because I know it back and forth. All right. So if we go down from 1990 to 1990, both sides, we start with $100,000 on both. At the end of 2019, USAIX is up to $626,000. All right, so we start with $100,000. We're up to $626,000. We've averaged 6.5% a year, roughly. We had one down year here, one down year there. We had 1, 2, 3 down years, 4, 5, and 94, 6. Did 90 down? No. So we have had 6 down years, and what's that? 21 years. All right, 6 down years in 21 years. We've averaged 6.51%. Since then, in total. So we averaged 6.51% with 6 down years. The worst we ever had was in 2008. It was down 5%. All right, now on the index, we've averaged 5.807%. So a 70 basis points reduction in terms of total amounts that we in total performance. 0.7 divided by 5.8. So we've underperformed by 12%. This fund right here is underperformed by 12%. The difference is $100,000 in total income, total account value. So at the end of 21 years or so, 20 years, that'd be 20 years exactly. No, 30 years, excuse me, 30 years, excuse me, 30 from 1990 to 2019. At the end of 30 years, that's why I did it for 30 years. This would have given you $528,000. This would have given you $626,000. So $100,000 different by sitting on the index as opposed to going to an actively managed bond fund, even though the actively managed had a little bit higher yields. All right, so we had 6 down years here. 1, 2, 2008, we had an up year. And that's how we know this was a government bond fund, because the only thing that did anything in 2008 was government bonds. So we had an up year in 2008. This had a down year in 2008. Inherently, this says this is more corporate, this is more government. That's literally all there is to it. And so we got 1, 2, 3, 94, 2, 4. So we had 4 down years here on the index fund, and 6 down years on the corporate bond fund. But now you can't say this is all government bond fund either, the index. Why? Because it has about 30 to 25 to 30% in corporate bonds. So you can't just sit here and say, well, you're comparing apples to oranges because this is a corporate bond fund, this is not. No, an index fund has corporate bonds in it too. That's just a fact. You cannot sit there and say, oh, they're not a fair comparison. Sure they are, absolutely. This just happens to have more corporate bonds. This happens to have more government bonds. And that's why this fund was up 5% in 2008. This one was down. All right, let's keep going. So now if we did 100,000 and we took 5% a year off. That's it. We're taking 5% a year off. What are we looking at? Well, after the end of 30 years, we took $211,000 out of the USA Income Fund, and we took $198,000 out of the bond fund index. So we've taken another 15,000 or so more of income from the USA fund than we did from the index fund. On top of that, we have 141,000 left in the USA fund versus 119 in the index fund. So we have another 21,000 plus. It basically made us about $40,000 more in income plus upside in the index than the actively managed in the index. And that's just all there is to it. So we've done better. In fact, look, even after we start, look, we got it's a little bit closer. It was 7,000 here in 2019, 5,000 in 2019, 6,700 in 2018, 5,700. So we're starting to get significantly in the 7,000 since 2009, where they're in the 5,000s. They had a little bit in the 7,000s, but there's 6. And the reason for that is just because they're not making enough. There's not enough upside. They're not making enough relative, because the interest rates are so low. The interest rates on government debt is so low that their income is actually declining, where the income on the index, on the non-index one, is actually increasing. Now, at least it's stabilizing, but an extra $1,000 a year is what the income is paying on the corporate bond fund or the actively managed relative to the index. And that, for the next 10 years, that's just going to continue on because you have more and more portfolio value than you do in the index. So I do not like the index funds. I think you should avoid them. And people say, oh, but Josh, you're cherry picking. All you have to do is look at any bond fund and see what the expense ratio is for an actively managed fund. If there's a low expense ratio and it maintains a nice diversified portfolio with some government, some corporates, some high credit quality, some lower investment grade credit quality, but as long as the fees are relatively reasonable, and I'd say 50 basis points or less, you could beat the index for sure. There's just no getting around that, because the way the index is now in terms of how heavy it is on the government side with these low interest rates, man, you can beat the index. All right, hope this helps. Love to hear your comments. We'll see you next time.